how do you see sentiment on Dalal Street amongst all this festive cheer, and what are you buying?
Clearly, yes, I think the festive season has further reinforced with positive earnings upgrades across various sectors. So that's welcome news. After 2 years, we are seeing revenue upgrades in the market for some of the important sectors in manufacturing, in banking. And banking is very important since it provides the liquidity and credit to the markets. And second, as there are revenue upgrades, therefore the valuations keep getting revised down because the multiples re-rate. And as a result, I think, the market, in spite of its about 10 odd percent rise in the last 1 year, still is very favorably priced.
Fair point. And where would you be deploying unit holders funds at this point of time? As you very rightly mentioned, the Nifty is up somewhere like 7-8% year to date as far as 2023 is concerned. But we've seen blowouts happening on the auto index, the PSU banking index, the pharma index, the FMCG index. Mr. Lokapriya, this is a crisis of plenty that we are facing on the Dalal Street. Where is your money getting invested?
Absolutely. I think you very aptly said it, captured it. It is a crisis of plenty. And that's the good news, which is because we're seeing so many upgrades across both the frontline as well as the broader market. And the broader market, even though it's done far better than the Nifty, still there are earnings upgrade. If you look at manufacturing, the large cap, which is L&T, the company is on target to, beat its revenue guidance for the full year, even after a very strong set of numbers. Now, if you go down the curve, all the various spending by the central government and the state government on infrastructure, defense, railways is paying out. And, this year, roughly 10 lakh crores is going to be spent by the center. The spending by the states is up about 42%. And therefore, and also the PLI incentive schemes for various sectors is all paying out well. And therefore, manufacturing, PSU banks, and as well as some pockets of defense and railway still look good.
Okay, these are some of the pockets. Keep an eye out on these. And Mr. Lokapriya, very good morning. This is Tanya joining in the conversation, and festive greetings to you, first of all. And actually, I want to discuss IT sector with you. I mean, we were discussing KPIT Tech, Birlasoft yesterday, and how, these mid-cap IT names are outperforming their large-cap ITs. So I want to understand from you that why are large-cap IT names not performing when you compare it with the mid-cap IT names?
The large-cap IT names have very strong order books. The problem has been in the execution of the order books. So there has been a delay in translating some of the order book into revenue. And that's because of the uncertainty that is happening in the US, in Europe. And because 90% of all the revenue comes from these two geographies, therefore they are facing that problem. On the other hand, the mid-cap IT companies are more sector-driven. Now, whether it's KPIT, which is more focused on manufacturing, where a lot of spend is happening in automation and move towards AI and some amount of towards machine learning. And therefore, the earnings, the order book is also being translated to revenue. Therefore, I think, these niche companies within the mid-cap will continue to do well. And as far as the large-cap IT, until the interest rates peak out, which is probably another few months away, until then, they'll probably tread water.
Okay, and what about these pharma stocks, Mr. Lokapriya? How is US FDA positioning itself on Indian pharma? And I'm asking this because of, ahead of the US elections.
Yes, usually every time the US elections happen, clearly there will be some amount of greater regulator scrutiny of all pharmaceutical companies. There will be greater pricing pressure. And so in the case of pharma, it is not a sector approach. It needs to be more stock-specific driven. And there are not so much earnings upgrades and revenue upgrades happening in the pharmaceutical sector. So outside of maybe individual companies like Alchem, we are largely staying away from pharmaceutical as a sector. because we are finding greater opportunities elsewhere.
So, in your answer, Mr. Lokapriya, rests my next question. Where do you see these opportunities in India, and how are you positioning fresh inflows in your India fund across the Lal Street? What is the breakup of buying blue chips, small caps, and mid caps?
Now, in terms of one is clearly power, and for the power sector, what we've done is power finance as well as REC Limited. These are the two government companies, PSU companies, which are lending across both the power sector and the infrastructure sector. In spite of the stocks have run up strongly over the last 1 year, the valuations are still very undemanding at trading at less than book value. And therefore, these stocks, again, with the new thrust on green energy plus a regrowth in the thermal energy, I think these are well positioned. Second, the companies which belong in that space, like the executors of that space, whether it is Suzlon, which has already run up quite a lot. BHEL now has had this fair share of run up. L&T. Then, if you look at the railway companies, Titagarh Wagons, then in the defense is Mazda. I think these companies are looking very good because Titagarh Wagons as a company was focused only on one sector, one division, which is the Indian Railways. But now metro, exports, all of them are opening up and therefore well positioned.
Okay. Mr. Lokapriya, does it bother you somewhere deep late in the night as to how PSU stocks have already run up very sharply, and the kind of rally that we've seen from April onwards in mid caps and small caps? You mentioned with great, how should I say, insistence and a very, very deep pocket about Mazgaon, about Titagarh Wagons. These stocks have gone up 3-4 times already. Does it bother you?
See, if you, I think this is a very good question. If you'll take Titagarh as an example, now this company has its what you call order book, which is clearly visible for the next 5 to 7 years. Most of the orders are coming from government or government-related entities, so which means the order book is secure, the payments are secure, and it's only the question of them translating to revenue and earnings. And even after all the run-up, you still have the company trading at about 22, 23 times, which is still a very attractive valuation multiple given its earnings profile for the next few years. And also in terms of the, when I said order book, it's a secure order book. And in terms of the margins, margins are improving with as it's moving down the ancillary chains. And also in export as a new source of revenue, which was not there earlier. Metro as a source of revenue, which was not there earlier. So therefore, I think, these companies not long neglected for many years, but now are looking good.
Okay, absolutely got that, Mr. Lokapriya. But we are at the fag end of the corporate earnings season. So, what do you make of the earnings so far?
Crude prices have come off. Generally, commodity prices have come off. That is providing a margin tailwind. Second, there has been an increased demand. Volumes are growing up, so there is a revenue uptick. And therefore, usually whenever there is a revenue uptick, these are not one-off. That follows a cycle. And in that cycle, I think there is the next few quarters of revenue upgrades that we will see, which means it indicates a recovering economy and recovering corporate India demand. And that's always good news because that creates the growth rates, the CAGRs for the next 3 years and 5 years. So in spite of and actually the markets, because as we discussed, is only at about 7-8%. So it's not overheated market. Individual pockets have gone up, but that's because they're long neglected. So I think as we go into next year, they will see, because an election year, we'll always have good amount of infra spending. Second, hopefully once the US interest rates peak, then we will start seeing further improvement in the recovery of the economy.
Right. Mr. Lokapriya, the other thing I wanted to point out was that you've been watching Indian markets for the last 25 years, and we've shifted from being a smokestack economy to an entirely digitized space, from the lowest raw material producer to the highest OEM manufacturer. When you see this transition in front of you, do you look at internet companies as long-term bets? These are, stocks that have come up on our radar over the last 2 or 3 years and have disappointed new investors but made tons of money for the PE space. How are you watching this one?
This comes and goes in cycles. Clearly, Amazon in the US went public some 30 plus years ago. And whereas the same type of companies are going public in India in the last 2 or 3 years. And so basically the same model readapted to Indian conditions when they went through a huge amount of multiple expansion and then a derating. So that is a natural path for the course which happens across markets. And they come and go in cycles, So from that perspective, as a space, there are lots of valuable companies coming out. But in terms of the valuations, I think, even now after the run-up of some of the companies like Zomato, I think it's time to, or even Nykaa, it's time to not plow further money into those companies. And the valuations is a function of at which point they get priced out, as you rightly said.
A bit of overvaluation creeping in simply because of the way liquidity is flowing incessantly into Indian stock prices. What would be those spaces?
I think those spaces are still clearly the new age internet companies. After companies like Zomato had fallen and then they've risen again. Now year to date, I think Zomato is up close to some 80-100%. And so the valuation is again creep back up. Yeah, and you'd take a company like Nykaa. Again, it has a fairly high level of debt, and therefore servicing that is also something what one needs to take into account in evaluations. So these companies have strong, sound business models, but it's still a long way to go for their profitability to improve. So I think there a bit of caution is advised.
Okay, absolutely. Got that, Mr. Lokapriya. But let's discuss PSU banking space as well. I mean, the numbers that are coming by, they are not that bad. I mean, if you look at SBI also, the bank posted good set of numbers. And there are some other large cap names as well. So we are getting good, stellar, I would say, second quarter numbers coming in from these banks. But what are your thoughts on PSU banking space and any stocks that you like from this particular space?
Yeah, among the PSU banks, I think if you take the large cap like SBI, or even the mid cap companies like Bank of India or Union Bank or Canara Bank, I think one of the important things that is all these companies are very attractively valued. Bank of India and Union Bank are still trading at about 0.7, 0.8 times book value. State Bank of India, being the largest bank in India, still trades at only at about 1.1 times book value. Now, before we get more into valuation, I think the important thing to recognize is India's growth, economic growth, has largely been led by services as an economy. Manufacturing represents hardly 15%. With the greater thrust in Make in India and PLI schemes, you're seeing a lot of initiatives by companies, and therefore manufacturing borrowing is increasing, and that borrowing largely comes from PSU banks. So they are the first beneficiaries of the Make in India initiatives and the PLI initiatives that are happening, and therefore their loan growth will be far higher than, let's say, the non-corporate focused banks. So against that, so when you have a very healthy top line loan growth outlook going into the next few years, then when a company, why should State Bank of India trade at 1 time book value, where some of its private bank counterparts of equal quality are trading at about 3 or 4 times book value? So I think that is the thesis. So therefore, there's still a long way to go for these banks to do well.
If you like the video, do like, comment, share and subscribe.